You retire with $800,000 sitting in a traditional 401k. Your neighbor retires with $400,000 sitting in a Roth account. Most people would assume you won. You didn't. These two people are not living the same retirement. They are operating under completely different rules, facing completely different tax consequences, and receiving completely different outcomes from identical spending habits. The person with half the balance comes out ahead, not because of inheritance planning, not because the market smiled on them differently, but because of what unfolds between the ages of 62 and 75. During those 13 years, three separate government systems collide in a way that quietly dismantles the larger account faster than any market downturn ever could. Meanwhile, the person with half the money positioned correctly holds on to more of every single dollar they actually spend. Here is your first data point, and I want you to genuinely absorb this before moving on. A 60-year-old in 2026 pays $515 per month for a standard benchmark silver health insurance plan through the ACA marketplace. That same 60-year-old identical state, identical plan, identical coverage, but earning $64,000 annually instead of $62,000, pays $1,244 per month. This is the exact same insurance product. The gap is $2,000 in additional annual income, generating $729 in additional monthly premiums, totaling $8,748 in extra costs every single year. The effective marginal tax rate applied to that additional $2,000 of income is 437%. Not 22%, not 32%, 437%. That is not a formatting error. That is the ACA Subsidy Cliff, and it returned with complete force on January 1st of this year after a 4-year absence. Standard retirement guidance tells you to save more. This video examines what that saving actually costs you when the moment arrives to use it. Here is the central argument. The number displayed on your retirement account statement is not your actual retirement figure. It is a gross figure, the same way an employer quotes your salary before deductions. The real question is, how much survives the journey from your account balance to your actual spending power? That answer is determined almost entirely by three things: which type of account holds the money, what income you report to the government when you withdraw it, and how 4 distinct government systems respond the moment you do. Every one of those systems will be examined here in full. The ACA Subsidy Cliff that returned at the start of this year, the required minimum distribution mechanism that activates at age 73 regardless of your financial preferences, the Social Security taxation formula that has not been revised since 1993, and the RMD Medicare Surcharge, which most retirees encounter when a letter from Social Security arrives, informing them their monthly premiums just multiplied based on income reported 2 years prior. Each of these systems, viewed individually, is an irritant. Viewed together, they can completely neutralize the financial advantage of having accumulated twice as much money. Consider how a car dealership operates. You walk onto the lot and the number printed on the windshield reads $40,000. By the time the finance manager finishes adding the destination fee, the documentation charge, the state taxes, the title transfer, the registration costs, and the extended warranty, he insists you absolutely cannot drive away without. You are signing paperwork for $46,000. The $800,000 traditional 401k is the windshield number. It is not the final price. Every time you pull up that account balance and see that figure, you are looking at a number the IRS holds a partial claim on. A claim they will collect. Not possibly. Certainly. The $400,000 Roth account carries a different sticker, one that sits much closer to the actual out-the-door figure. The tax obligation has already been settled. What you see on the screen is much closer to what you actually keep. This car lot comparison will resurface repeatedly throughout this discussion because it becomes more accurate and more alarming with each additional layer of the system we examine. There is a foundational flaw embedded in how the retirement planning industry addresses all of this. The projection tools, the marketing brochures, the retirement readiness assessments, the 4% withdrawal guideline, virtually everything in common use operates at the sticker price level. These tools model how large the account is and how long before it reaches zero. They almost never model the simultaneous interaction between your withdrawal sequence, your pre-Medicare health insurance expenses, your Social Security taxation exposure, and your Medicare premium surcharges all occurring within the same calendar year. Because that requires tracking 4 moving variables at once, and 4 moving variables cannot be compressed into a pie chart. Having spent more than a decade running my own business alongside accountants and tax attorneys, watching precisely how money flows through each of these systems, the thing that caught me most off guard was not how complicated it all was. It was how consistently avoidable most of these outcomes are once you understand exactly where the boundaries sit. In a few minutes, we will examine what occurs at age 73 when the federal government converts your retirement account into a mandatory income source, whether you requested the withdrawal or not. But first, let us examine why the decade preceding that moment is one of the most financially treacherous stretches in American retirement, and why it disproportionately penalizes the people who saved the most money in the wrong type of account. You leave the workforce at 62. Medicare coverage does not begin until 65. That creates a minimum 3-year gap, potentially longer depending on when you stopped working, during which you are purchasing health insurance on the open market entirely on your own. Before January 1st of 2026, this gap was painful but survivable. Legislative expansions through the American Rescue Plan and the Inflation Reduction Act had extended ACA subsidies broadly enough that premiums were capped at 8.5% of household income for all enrollees, regardless of earnings level. There was no income ceiling. The cliff had been temporarily eliminated. That provision expired on December 31st, 2025. Congress did not renew it. The cliff has returned. Here is the precise mechanism. ACA subsidies in 2026 terminate completely at 400% of the federal poverty level. For a single individual, that ceiling is $62,600. Earn $1 beyond that threshold and every subsidy dollar disappears. Not reduced gradually, not phased down over time. Gone entirely and immediately. A detailed policy analysis of this exact scenario assigns specific dollar figures to the outcome. A 60-year-old earning $62,000 annually pays $515 monthly for a benchmark silver plan. That same 60-year-old, same age, same plan, earning $64,000 annually pays $1,244 per month. The monthly delta is $729. Annualized, that equals $8,748, triggered by $2,000 in additional income. That is the mechanism at work. Not a tax bracket. Not a gradual phase-out, a cliff. $1 past the threshold, and you absorb the full unsubsidized premium for a 60-year-old. In numerous markets across the country, that unsubsidized annual premium exceeds $14,000. Here is precisely how the person with $800,000 in a traditional 401k gets damaged. To fund their retirement lifestyle, they must pull money from their IRA. Every dollar withdrawn from that account is classified as taxable ordinary income. It gets added directly to their adjusted gross income and reported to the IRS. If they need $60,000 annually to cover their actual costs, including food, housing, and travel, the mathematics require grossing up that withdrawal. After applying the standard deduction of roughly $15,000, the taxable portion of a $75,000 withdrawal gets taxed at 10%, 12%, and 22%, depending on which income segment it falls into. They net approximately $60,000 after federal taxes. That part works. Except their gross income reported to the IRS and to the ACA marketplace is $75,000. The single filer ACA cliff sits at $62,600. They are already $12,000 past the threshold before paying a single utility bill. Health insurance costs $14,928 per year, consumed before groceries are purchased. The person with $400,000 in a Roth account pulls $60,000 from her Roth. Roth distributions are entirely excluded from income calculations used to determine ACA subsidy eligibility. Her reportable income for healthcare subsidy purposes might be $10,000 from a small dividend-producing account, plus some interest income. She qualifies for a meaningful subsidy. Her monthly premium might fall below $300, under $3,600 annually. Annual healthcare savings between $11,000 and $14,000. Not because she has more money, because her money sits in the correct type of account. For married couples, the arithmetic becomes even more dramatic. The ACA cliff for a two-person household in 2026 lands at $84,600. A couple requiring $70,000 to sustain their lifestyle, pulling from a traditional 401k where the gross withdrawal must reach approximately $88,000 to net $70,000 after taxes, is already beyond the cliff. Their unsubsidized premium in many states exceeds $22,000 annually. Documented cases show premium increases exceeding $30,000 per year for certain couples residing in high-premium markets once they cross that boundary. $30,000 in annual health insurance costs because their gross withdrawal landed a few $1,000s past the threshold. Consider the full mathematical impact of that situation. The person with $800,000 in a traditional account might require $75,000 to $90,000 in gross withdrawals just to net $60,000 to $70,000 after accounting for taxes and insurance premiums. The Roth account holder with $400,000 draws far less from their account to sustain the identical lifestyle because their insurance is subsidized and their withdrawals are completely invisible to these income-based systems. That is the sticker price versus the out-the-door price made real. Both portfolios appeared adequate for retirement. The actual receipts told an entirely different story. You had a conversation with your financial advisor. He reviewed your numbers. But did he run the ACA cliff analysis? Did he place your income figure, your subsidy eligibility, and your projected premium cost into the same spreadsheet simultaneously? Most do not, because most retirement projection tools were engineered to forecast account balances, not to model the interaction between income level and government benefit calculations. These tools were built for the accumulation phase. You have spent decades accumulating. Now you are decumulating. And decumulation operates under a completely different set of financial physics. The ACA cliff is a painful experience, but it concludes at age 65 when Medicare eligibility begins. What follows does not conclude, and it begins with a government letter you receive in your early 70s, politely informing you that withdrawals from your own account are now mandatory. Your preferences on the matter are irrelevant. At age 73, the IRS mandates that you begin taking required minimum distributions from every traditional IRA and 401k account you hold. This is not an elective provision. Under the Secure 2.0 legislation, the penalty for failing to take your full required distribution is 25% of the amount left undrawn. The government extended patience for 3 or 4 decades while these accounts grew. The deferred tax bill is now being called. The calculation is straightforward. Take your account balance as of December 31st and divide it by the IRS life expectancy factor assigned to your age. At 73, that factor is 26.5. At 75, it falls to 24.6. As you age, the divisor shrinks and the mandatory distribution grows correspondingly larger. Here is what this means in concrete terms for the $800,000 account holder. They retired at 62. If that balance grows at 6% annually over 11 years, a completely reasonable assumption for a diversified equity-weighted portfolio, it reaches approximately $1.5 million by their 73rd birthday. $1.5 million divided by 26.5 equals $56,600 in mandatory, fully taxable ordinary income every single year. Add Social Security benefits. The average retired worker receives approximately $24,800 in annual benefits in 2026 following the 2.8% cost of living adjustment. This individual now has roughly $81,000 flowing in annually, approximately $57,000 from the IRA distribution, and $24,000 from Social Security. Almost none of this income was chosen in this specific amount or at this specific moment. Now comes the tax cascade, and this is the point where the sticker price comparison collapses in the most expensive way imaginable. The Social Security benefit taxation formula functions as follows. You compute your combined income, which equals your adjusted gross income, plus any tax-exempt interest earned, plus 50% of your Social Security benefit. If that combined income as a married couple filing jointly surpasses $44,000, up to 85% of your total Social Security benefit becomes taxable income. Not 30%, not 50%, 85%. And that threshold, $44,000 for joint filers and $34,000 for single filers, has not been adjusted since 1993. In that year, the average Social Security benefit paid out less than $8,000 annually. Today, it approaches $25,000. Those thresholds were originally calibrated to tax upper-income households in 1993. They now automatically sweep the middle class into taxation every year as annual cost of living adjustments push benefits higher against fixed thresholds that were never indexed for inflation. Our individual with $1.5 million generating forced distributions is sitting at $81,000 in combined income, far exceeding the $44,000 threshold. 85% of their Social Security benefit is now taxable. That adds another $21,000 to their taxable base. Their effective taxable income after standard deductions and the senior bonus deduction available in 2026 still lands them firmly inside the 22% bracket, producing a federal tax bill approaching $15,000 per year on money they were effectively compelled to receive. Then Medicare applies its own charge, RMAA, the income-related monthly adjustment amount, is a surcharge layered onto your Medicare Part B and Part D premiums when your reported income exceeds specified thresholds. In 2026, it activates at $109,000 for a single filer and $218,000 for married couples filing jointly. The standard Part B premium runs $185.00 per month. Cross into the first IRMAA tier as a couple, and that figure rises to $259.00 per person per month. At the highest income tiers, the monthly premium climbs to $628.90, more than triple the base amount. Here is the element that genuinely blindsides people. IRMAA is calculated using your tax return from 2 years earlier. Your 2026 Medicare premium is determined entirely by what appeared on your 2024 tax return. A substantial Roth conversion executed in 2024, a one-time capital gain from selling real estate, or any year of unusually elevated income for any reason, will follow you directly into your Medicare billing 2 years later, even if your income has since declined to nothing. Most people learn this only when the letter from Social Security arrives, and $1 beyond any IRMAA bracket threshold triggers the full surcharge for the complete calendar year. For a married couple, crossing from the standard rate into the first tier costs approximately $2,297 additional per year for each enrolled spouse. That is a potential premium spike of nearly $4,600 per year for the household because of one extra dollar of reported income. This is the complete cascade the $800,000 account holder walks directly into. At age 73, mandatory distributions trigger ordinary income tax. That income triggers Social Security taxation at the 85% inclusion rate. The combined income may push Medicare premiums into an elevated IRMAA bracket, which is determined by income from 2 years prior anyway. So you are managing an echo effect. 3 simultaneous tax events firing from a single source, the traditional IRA balance. The Roth account holder faces no required minimum distributions during their lifetime. They withdraw what they need when they need it in amounts that keep their total reported income within the most favorable bracket available. The cascade has no trigger because there is no ammunition to set it off. Here is a figure that should make all of this concrete and real. Across a 20-year retirement, the cumulative gap in taxes paid, health insurance premiums absorbed, and Medicare surcharges incurred between someone drawing primarily from a traditional account and someone drawing primarily from a Roth while maintaining an identical lifestyle can exceed $200,000. Identical spending, completely different receipts. That is the real exit cost embedded in the sticker price retirement. The account said $800,000. The out-the-door number was something else entirely. Here is the part that never appears inside a standard retirement calculator. Understanding these figures intellectually is one thing. Constructing an actual withdrawal strategy around them before you stop working is an entirely different discipline. Most advisors collecting 1% of your portfolio annually will explain one or two of these mechanics individually. They rarely walk through all of them together. They almost never present a specific income plan showing precisely which account to draw from in which year to minimize the interaction between these systems. The digital book I put together called The Exit Code contains 8 chapters of actual retirement data spanning 50 years, distilled into a mathematical framework for determining specifically when the numbers confirm you are financially finished working, not when you feel ready emotionally, when the math provides confirmation. 2 sections connect directly to everything discussed here. The dynamic withdrawal method replaces the flat 4% guideline with a system that adjusts based on your current tax bracket, your income-dependent benefit eligibility, and your account composition at any given time. Because a fixed 4% withdrawal from a traditional account that ignores the ACA Cliff and the RMD cascade is not a withdrawal strategy. It is wishful thinking. And the Social Security Bridge strategy explains how to delay claiming your benefit to age 70 in order to capture the guaranteed 8% annual delayed retirement credit without depleting your accounts entirely while you wait. The complete resource is available through the link in the description for less than a typical dinner out. Every year you defer building this framework, the compounding gap works against you. Not catastrophically, relentlessly. Stay with this because the next section shifts the fundamental question entirely. We have been asking how much you saved. The question that actually governs your retirement outcome is different. Where did you save it, and in what sequence do you spend it? There is a figure almost no one deliberately optimizes for. It is not your total account balance. It is your effective marginal tax rate on each dollar you spend throughout retirement. Because when you hold 4 potential income sources simultaneously, a Roth IRA, a traditional IRA, a taxable brokerage account, and Social Security, and you need $60,000 per year to fund your lifestyle, you possess genuine choices. The sequence in which you draw from those sources determines whether you activate the cascade or sidestep it completely. Here is how the intelligent version actually operates mechanically. You withdraw $25,000 from your Roth account. Taxable income generated, 0. You withdraw $15,000 from a taxable brokerage account, holding positions you have owned longer than 1 year. If your total income remains below approximately $48,000 for a single filer in 2026, those long-term capital gains are taxed at 0%. Not 15%, not 20%. 0. You draw the remaining $20,000 from cash reserves accumulated during your final working years. Your total reported income for the year is $15,000 from the brokerage account. You are nowhere near the ACA Subsidy Cliff. You are nowhere near the Social Security taxation threshold. You have not generated the trigger that sets the cascade in motion. Now contrast that with someone who withdraws $60,000 directly from a traditional 401k. The spending amount is identical. The taxable income is dramatically different. The ACA premium is different. The effective tax rate is different. The Social Security taxation status is different. The purchasing power achieved is the same. The tax receipt is absolutely not. The 3-bucket retirement framework covering taxable accounts, tax-deferred accounts, and tax-free accounts is not a new concept, but the majority of conversation around it centers on the accumulation phase. Contribute to all 3. Diversify your tax exposure across account types. What receives far less attention is the decumulation sequence. Which bucket you draw from in which order and how you manage the specific interaction points, where one bucket's withdrawal influences the effective tax rate applied to another bucket's income. There is an instructive comparison here. Consider a farmer who pays for seed at planting time versus a farmer who defers payment until harvest. The farmer who defers payment appears wealthier during the growing season. More cash available when it is needed. But at harvest, when market prices are uncertain, when the counterparty sets the terms of settlement, when the rules governing the transaction have shifted, the bill arrives at the least convenient moment imaginable. You cultivated the yield. You do not get to set the price on the day you collect it. The IRS does. The traditional IRA and 401k are deferred payment retirement instruments. You did not eliminate your tax obligation. You arranged a payment schedule and the payment comes due at a time and in an amount that the government controls, not you. This brings us to the Social Security delay strategy, which is where the Roth account holder can construct a structural income advantage that continues compounding for decades. Postponing your Social Security claim from your full retirement age to age 70 adds 8% annually to your eventual monthly benefit. If your full retirement age is 67, waiting from 67 to 70 increases your permanent monthly benefit by 24%. That increase is guaranteed and indexed to inflation for the remainder of your life. For anyone born in 1960 or later, claiming at 62 instead of waiting until 70 locks and permanently just 70% of your full benefit rather than 124%. That gap, experienced across a retirement that statistically extends into the mid-80s for someone reaching age 65 today, is financially substantial. The trap works like this. If you need income between 62 and 70 and every dollar you own sits inside a traditional IRA, every withdrawal for living expenses creates taxable income. That taxable income places you on the wrong side of the ACA cliff before Medicare begins at 65, potentially triggers Social Security benefit taxation. Once benefits finally commence and can establish your IRMAA baseline for Medicare premiums, based on the 2-year look-back period. The very strategy that would maximize your eventual monthly Social Security check, waiting until 70 to claim, is actively working against you during every year you are funding your life from traditional IRA withdrawals. The Roth account holder can bridge those same years by pulling from Roth funds. Zero income generated. Zero ACA cliff exposure. Zero Social Security taxation trigger activated. They reach age 70 with a monthly benefit that is potentially 77% larger than if they had claimed at 62, and they paid no tax penalty to finance the wait. Here is the element most people assume requires perfect foresight, because everything described so far sounds like a problem you needed to solve 2 decades ago when originally deciding between pre-tax and Roth contributions. But that assumption is not entirely accurate. The Roth conversion window is the period spanning from your retirement date to age 73 when required minimum distributions begin. Retire at 63, RMDs at 73. That is potentially a full decade during which your income may be the lowest it will be for the remainder of your life. No employment income. No Social Security yet if you are deliberately delaying. No mandatory IRA distributions yet. In many scenarios, your taxable income rests close to zero. That is not a financial problem to solve. That is the single most valuable tax planning window available in your entire financial life, and the majority of retirees use it for nothing.